You're watching Deal Flow, the show that tracks merger and acquisition activity on the continent. I'm Erika van der Merwe. We're taking our cue this week from a new report on deal flow in Sub-Saharan Africa. And there's good news in the numbers, with strong growth in deals in the first half of this year. We find out what the top sectors and regions are right now. We get you in the mood for that with the deals of the week. BP's former chief executive John Browne is to preside over the biggest set of oil and gas assets in the shallower, mature section of the Gulf of Mexico after buying them from the US. Nigeria's Guaranty Trust Bank has reached an agreement to acquire a 70% stake in Kenya's Fina Bank Limited for $100 million. DELL postponed until Wednesday a shareholder vote on its chief executive's $24.4 billion buyout offer. Michael Dell failed to gain sufficient support to seal the deal, despite winning over several large investors at the 11th hour. And in South Africa, logistics group Imperial Holdings is selling its tourism division to Cullinan Holdings. The purchase price will be settled by the issue of over 81 million shares in Cullinan to Imperial. The transaction will result in the Imperial Group acquiring about 10% of the shareholding of Cullinan. And banking group FIRSTRAND's bid to acquire a stake in Merchant Bank Ghana was unsuccessful, setting back plans by South Africa's second largest lender for a retail operation in oil-rich West Africa. According to a report by Thomson Reuters, the value of announced M&A transactions in Sub-Saharan Africa reached nearly $16 billion during the first 6 months of 2013. That's up 86% from the same period last year. This is the best first half in the region since 2010. In studio with me, Keith Nichols, Managing Director of Africa for Thomson Reuters, and Michael Bosman, Director for M&A at Ernst Young. Welcome. Good to have you here. Keith, I'm starting with you. It's your report. Essentially, you're actually tracking fees earned by investment bankers, which is a story in itself, by doing advisory work in the African region. But that gives us an insight into the level of deal flow activity. So we've said it's good news, nearly $16 billion in the first half of the year. But as these things usually are, it's pretty lumpy. So there are two biggish deals in there in Mozambique, and that alters the story.
Yes, absolutely. I mean, I think the story here is that while overall deal value for the first half of 2013 is definitely up, it is a point in time, so it is dangerous to draw inferences from it. And you're right, when you strip out the two large deals in Mozambique, it sort of shows that deal value is sort of flat, but overall volume is the same as the same period of last year, so total number of deals versus values.
Mike, what's your experience of the advisory work that you're doing? Is deal activity flat? We know there's a great deal of optimism, so presumably everyone's scurrying around looking for opportunities.
I think what we're seeing is very consistent with what Keith has presented in the report. We're seeing, again, as you rightly say, there is a lot of activity, so there is plenty of money out there. There is a deficit of real quality assets at attractive prices that we see out there. Aligned with that, we're also seeing a difficulty in closing deals. So we're seeing the average time of completion probably drifting out for a number of transactions. And a lot of big transactions, by the nature of their complexity, are also not closing. So I think what we're seeing is consistent. We're not seeing a level of consistent M&A activity above what we were seeing prior to the global financial crisis.
Let's pick up on that point you just made about a deal closing, that period's being extended. First of all, do you have a metric of how that period, how long it takes to close a deal, compares with what you're seeing in other regions?
Yeah, I mean, if you look globally, I guess a benchmark would be that on average over a genuine four-quarter period, you would have typically expected around 67% of deals, announced deals, to have closed. We've seen that number come down significantly to low 60, 61, 62% internationally. And what we're seeing is very consistent here, if anything, probably a little bit worse. So that's on the percentage of successful deals. In terms of the time taken within the successful deals, we've seen a gradual uptick, certainly globally, from 47, 48 days on average up to over 50, 52, 53 days. So we've seen that internationally, and certainly the experience that we've had on specific transactions would bear that out.
Keith, presumably it's a matter of sentiment. There are other factors. Mike, you refer to the complexity in Africa, but sentiment is a factor globally. Funders who are doing the deals, that it might be taking them longer to commit and to find the funding.
Yeah, absolutely. I mean, I think when you look at the data in the report, you see a lot of the larger deals are from nations that are comfortable with investing in Africa. So you see the 2 large deals from China. You see the other deal from India, but then you see the majority of transactions coming from South Africa, within South Africa. So there's that certain comfort level of investing in Africa that comes with that.
Expand on that. So it's still, I think, in that statement of yours, South Africa within South Africa, still, despite all the talk, and we have seen years now of operational expansion by South African companies, but still, in the bigger scheme of things, limited deal making by South Africans in the rest of the continent?
That's what the data shows for at least for 2013. Again, it is a point in time, the report, but if you look at the report throughout time, it does show that story that the majority of South African investment is within South Africa. There are people that venture into the continent, or companies that venture into the continent, but by far it's in South Africa.
Yes. And Keith, just to repeat what you said, so China's in there, South Africa's second on the list in terms of who's doing the deals. India's there, interestingly, Brazil and Zimbabwe.
Well, if you look at the Zimbabwe deal is the Zimplat's deal. So if it was sort of a mandated sale, if you will. So it's a very large deal, but the deal was sort of mandated by the government. So it's about $1 billion, I believe. So if you strip that deal out, Zimbabwe sort of falls. It's just one deal. Brazil, I think, was again an oil company as well. So investing in the Africa story there as well.
And the Africa story, Michael, it's no longer just a resources story. Although many of these themes still are resources, but it's that the emerging middle class. It's the population dynamics.
Very much. I think the data is always clouded by 1 or 2 large deals, as you talk about, and they tend to be resource-based. So when you talk about the Brazilians, you're talking about some of the Angolan deals, you talk about the Chinese, they would tend to be very resource-heavy. But you're absolutely right in terms of a number of the middle-class consumer story deals. So we are seeing continual focus on the retail space. We're seeing continual focus on consumer packaged goods, buying brands, buying positioned in market, a lot of interest in that. And then as we go further down, the knock-on industries, so retail, shopping center building, there's a lot of interest in growing the retail space which is available, which will feed again on the consumer stories. So that's all positive and a maturing of the market, which should over time lead to more consistency and stability in the overall M&A space.
Yeah. And as you're seeing that maturation still happening, I suppose the questions are, what are the hot sectors, what are the hot regions, but also in which country is it easy and feasible to do deals? What are your experiences?
I think there's a number of different possible twists on that. The reality is that due diligence is critically important to any of these major transactions. And there's varying degrees of difficulty and complexity which would be exhibited in different geographies. So we all know that it is difficult to do transactions in Nigeria. One needs to be very focused on diligence, etc., and we're seeing that with a lot of our clients. But to your earlier point, Erika, that we've also seen, I guess, a second round and a maturing of a number of the South African corporates that are now onto their 4th or 5th deal. They've been doing transactions in Africa for the last 15 or 20 years. They understand a lot of the issues and the dynamics. So from that point of view, they are, I guess, becoming more experienced deal makers. And you raised the earlier point about FIRSTRAND and RMB. In a sense, one of the maturing processes is your ability to walk away as well and to be a disciplined deal maker and not just pay any price. And I think that's one of the factors that we're seeing in the market as well, which over time, certainly if the international data is to be believed, that's really what generates the returns.
Keith, perhaps that touches on deal size as well, because I understand the corporates and the private equity buyers looking for deals that might be in the bigger scale of things, and there aren't all that many around, so there could be competitive bidding processes there. But what are the deal sizes looking like from your data?
Well, like I said, the top 10 deals of that roughly 16 billion US, the top 10 deals represent nearly 90% of that. So the deal volume of the other 198 deals that happened in the first quarter are under 200 million. So there is a lot of smaller size deals and a lot of money chasing those smaller size deals. So you're probably right in inferring that there's a lot of competition for those deals.
Investment bankers might not be interested in those smaller size deals. Michael, what's your opinion on that? So the pipeline might not be coming from the investment bankers, but perhaps more from more less formal networks?
I think one needs to look at the advisors that would be on either side of the transaction. So one of the issues that you raised earlier was the slow time to completion and the potential number of deals that are not completing. And part of that is because in some of the markets, particularly West Africa, you see quite an informal promoter type network. And the problem is that a lot of those promoters have created unrealistic expectations. So whether it is an interesting business for the investment bankers, it's very much a question of, will you establish a solid position in country, in these markets to be able to service? And I think the evidence suggests that certainly the big South African banks are interested in pursuing that business. They are interested, and over time that should probably normalize the state, because you'll get more professional deal processes, you'll get more realistic seller expectations as to what the values are that they should be looking for from their transactions, and that's all a maturing and a professionalizing process.
By implication, there still is a valuation gap, so what buyers are willing to pay versus what the selling price is.
Absolutely, and that's obviously quite extreme in the commodity space, because we've seen with the relative slowdown in China and the fall off of a number of the commodity prices. What we've also seen is a number of quite high profile, what we would call mega deals north of $1 billion, not completing, largely because seller expectations hadn't tapered to the same degree that buyer expectations had tapered. So I think that is a phenomenon, but with the professionalizing of the space and increasingly more of the global investment banks being in these markets, I think you will see a closer alignment of buyer and seller expectations.
And Keith, because you're tracking the fees generated by investment bankers by type of activity. Now, if you look at that kind of activity outside of South Africa, it gives you an idea of what the funding instruments might be. Correct me if I'm wrong, but you refer to syndicated lending, debt capital markets and equity capital markets. So I would hazard a guess that outside of South Africa, equity capital markets activity is less active than debt capital markets and lending?
Yes, absolutely. I mean, that's what the data shows. I mean, at least, again, for the first half of 2013, that the equity capital markets from an investment banking fees perspective is down, and down fairly significantly. And so funding sources are coming, or fees for investment banking are coming from more of the syndicated loans. That's where investment bankers are going out and arranging loans from various groups to fund companies' activities. And so that activity was actually up in comparison to last year's data, but equity issuance and advising on equity issuance or follow-on issuances is down.
Michael, perhaps you can close on that point. So what are you seeing that the various funding options and instruments, also another element of the maturation of this market?
Yeah, and I think it's an absolutely critical point. If you look in West Africa, domestic funding for some of these transactions is prohibitively expensive. You're paying domestic interest rates of 20 to 23%, which mean then you've got to look for a set of funding instruments which will make a deal more attractive, and then you're dealing with currency risk if it's financed offshore. So that deepening of the capital markets and the availability of a variety of different sources of and instruments to fund these deals is absolutely a critical development that we will see, and we are seeing.
Michael and Keith, thank you very much indeed. My guests were Keith Nichols, Managing Director of Africa for Thomson Reuters, and Michael Bosman, Director for M&A at Ernst Young. And that's it for this week's edition of Deal Flow. Thanks for being with us. We'll be back in a week.